Hey clients and friends, I wanted to send you all a last quarter of 2022 update here before the holidays hit us and then things get a little bit crazy. I want you to know what's going on in our real estate market. So I'm going to throw a bunch of stuff at you that I just want you to hear about our real estate market. There's a lot of stuff going around about the real estate market in the news and people talking in social media and also just like a dinner or in the family. And I want to tell you what's really happening in the market. So a lot of people are talking about our real estate market crashing, waiting for the real estate market to crash, waiting until next year to purchase, waiting until next year to sell because the market has crashed or is going to crash and they're feeling it out. These are the things that they say: crash, 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 right? Well, here's the realities. So, right now, as we sit, inventory is still a quarter of what it was in 2008 when the market started to crash. Okay? So let me say that in another way. So if there were 100 houses on the market in 2008, there are 25 houses on the market today. As you guys know and can pick up, obviously in 2008, demand was much less because there were 100 homes available versus now there's 25. Okay? So inventory plays a huge role in housing demand, and we're still at a quarter of in inventory of what we were in 2008 when the market started to crash. Distressed properties, short sales, HUD homes, government-backed home sales are pretty much non-existent right now. Okay, so when the market crashed in 2008, about 30% of the inventory was distressed homes, short sales, bank-owned homes. Right now, across our country, sales for distressed homes only equate to be about 2%. Short sales are basically almost impossible right now because there is so much equity in the home that if people even get behind on their mortgage payments, they can cash out, refinance, and pay them off. They can refinance the loan even with higher rates because they have so much equity, or they can sell and they don't have to take a loss because home appreciation has been so high. So short sales, bank owns, those kind of things are pretty much non-existent. We've had some people start talking about bank-owned homes and wanting to find bank-owned homes, and they're still existent because homes still have a great amount of equity because home prices haven't fallen. Okay? We have seen about a 25% decline in sales activity this month and last month compared to last year in October and November. Why is that? It's rates. It's simply rates, okay? Rates were at 3% at the beginning of this year, and then they went up to 7%. Now they're back down to about 6%. It's rates. Rates are driving that, and we as consumers have knee-jerk reactions when things become less affordable. We also just have to make sure that things are affordable, right? And when rates went up, every single time a rate goes up 1 point, it makes about 10% of the buyer population drop out because of affordability. The house became 10% less affordable. Okay, so another way to say that, if a mortgage payment was $1,500 at a 3% interest rate, when it became a 4% interest rate, that mortgage payment went up to $1,650. Okay, when it became a 5% interest rate, that mortgage payment went up to about $1,850. So every single time 1% increase goes up, it goes up about 10% in cost, and so that means it's 10% less affordable. So that's why we're seeing this decline in activity, about 20 or 30% of a decline in activity in the market, and it's really rates based. What we believe and what economists are saying is that if rates hold or they drop, we believe that our market will likely increase next year. Activity will increase for a couple of reasons. One, people just get conditioned, right? So after about a year of seeing interest rates either stay the same or even drop, like if buyers see rates at 6% and they hold at 6% for a year, that becomes the new normal. So the sticker shock wears off. So buyers might be looking at some cheaper homes to make sure that they are affordable, but they will get back into the market because the sticker shock wears off and we get conditioned. Also, we might actually see homes, their prices decrease a smidge, okay? When the real estate market bottomed out across the country, real estate values bottomed out and they dropped 30 or 40%. That was major. Economists think that we will either hold steady in pricing or we may drop about 3, 5, 6%, especially in the steady Midwest where we live here in Indy. We may only see a few percentage points dropping. In states like California, where prices went sky high, they're going to see a larger price reduction. They're going to have a larger price reduction conversation, right? So as homes might reduce a small amount in value, buyers will also get back into the market after they've been conditioned on the rates. So we think 2023 and 2024 could be a strong rebound. If our economy still holds strong, inflation comes down a little bit, the bond market pushes back on interest rates a little bit more, we'll see interest rates probably go down again too. And if they go down, we'll have a feeding frenzy because remember what I said about inventory. We only have about a quarter of the inventory in the market. And so we see this real estate market kind of picking back up again in 2023 and 2024 if the rates go down or hold and the inventory stays the same. So we might see a small, decrease in pricing, but we don't see a huge one. This is a completely different story than last time, okay? So if you own a home, I also want you to hear that yes, prices might go down a few percentage points just because buyer demand pulled back, because buyer affordability pulled back. However, over the last 5 years, your house has appreciated about 65% in Indianapolis. Okay, that's a huge number. It's a huge number. So if you need to move and you need to sell, your homes do sell in this market. They just take a little bit more time. And about 30% of the buyers are no longer in the market. That means 70% of the buyers are still in the market. Okay? So it's just going to take a little bit longer to find them. If you need to buy a home, make sure that you look into things alongside a realtor like an adjustable rate mortgage or a 7-year ARM where your rates could be down in the 5% or so, and then you could refinance within 7 years. Honestly, I will also tell you that if you get a rate in the low 6%, historically, that's a pretty good rate, but I don't even want to talk about that. I want to talk about how houses in Indianapolis on average appreciate at least 6% a year for the last several decades, okay? So if you bought a house with a 6% interest rate today and you sell that house in 10 years, if the numbers still flesh out, you haven't lost anything. You've paid in interest what the house has appreciated, and if it appreciates more, you're ahead, okay? So buying a house, you always win. If rates stay the same, you win. If rates go down, you win. If rates go up, you still win, okay? Home appreciation is king. It's just like being in the stock market. The longer you're in it, the better you are, okay? Now, that sounds salesy, and I understand that. I'm a real estate broker, and that's what I try and do is I sell homes. But guys, look at the numbers. Go to Google and type in home appreciation over the last 50 years and just see for yourself. If you own a home for a long time, you do gain wealth, okay? Rich people hold homes. And if you want to gain wealth, you want to grab a home and hold it, okay? All right, you guys take care. This is a very long form video, but I wanted to send it to you. End of the year update. Hope you are awesome, and I hope that we can talk soon. We'll see you. If you need anything, reach out to me online. Reach out to my email, patrick@crestpointindy.com, or you can text me. I just text you this video, 317-364-5858, and we'll talk. Have a great Thanksgiving, a wonderful Christmas, and we'll be in touch. Also, come to our Pie Day this Thanksgiving and bring a blanket for kids in need. We'll see you. Bye.